Now, to give you an idea of what sort of magnitude we're talking about, look, and I urge you to go, if you haven't done this already, because we use Qantas for a lot of examples, go and get their annual report. Like, if you don't have to obviously print the thing off, go and download it and just have a look at this. And we've even given you which note to look at. They've got, for context, about $21 billion worth of assets and about $15 billion worth of liabilities, just to give you a sense of where they're at the moment. That gives you a leverage, so liabilities over assets of 72%. Now, not surprising considering they've got quite a lot of heavy duty equipment sitting there. Of their total assets, around about 2/3 or $14 billion is property, plant and equipment. Now, of that property, plant and equipment, over $3 billion of that is leased. So that $3 billion of that $14 billion they do not own. They lease those assets, and it falls under what we call a finance lease, and those are brought onto the balance sheet. And that's a reasonable proportion of their total property, plant and equipment. But that's not the interesting bit. The regulators, a lot of user groups, they're happy with this. That's actually what they want to see more of. What they're unhappy with, explicitly, are these things. They're unhappy with those things because, and even though we haven't looked at what an operating lease is yet, just bear this out, that operating leases do not come onto the balance sheet. You do not see any assets or liabilities associated with them. Now, that would be normal, for most parts, an operating lease is, me going off and hiring the car for 2 months. If I had my books, I'd just, debit expense, credit cash, that would pick up that. I wouldn't be debiting car, credit, lease liability. I wouldn't be doing anything like those things. I would just show, as I pay money out, I've got an expense. But for a lot of these ones, these can be quite long term. And the total that they're talking about of the non-cancelable operating leases, so they have, and I'll back this up a bit, think about what the definition of a liability is. You have a present obligation. They have a present obligation. They've got a present obligation of around about $3.5 billion of something they cannot get out of. They are going to be paying this. To me, and to a lot of people, I suppose in the standard setting world, and to a lot of other people, that looks like a liability. That looks like something that should get brought on the books. So if we're trying to narrow down what the problem is, it's that companies are doing this. And when you consider that they've got $21 billion of assets on the books and $15 billion of liabilities, that is not a small proportion of the sums that we're looking at. If you were to bring that onto the balance sheet, you'd add 3.5 there, you'd add 3.5 here, and this would jump up to 76%. That may not cause a problem, but it may cause a problem for them. So you can already see why companies, if they can prefer it, would push things off balance sheet. And that's exactly what this is called, is off balance sheet financing. Now, just to give you an idea of the magnitude of the problem worldwide, in 2005, the SEC, so this is going back 8 years ago, I'd imagine this is a larger problem now. In 2005, the SEC estimated that US public companies may have approximately $1.25 trillion of off-balance sheet undiscounted operating lease commitments. So in terms of that $3.5 billion there, just in the US, they're talking over $1 trillion of these things, which are not on balance sheet. According to the World Leasing Yearbook, in 2011, new leases entered into amounted to almost $800 billion. So that's just new leases going into that year. This is not a small issue. We'll talk a little bit about what the IASB is proposing to do or has proposed to do towards the end. But it is a significant issue. Maybe it'll change, but as I said, it's been 8 years and nothing has happened to this point, so it's probably going to be a number of years to go. So there's a divergence between economic substance and legal form. Economic substance suggests we bring it onto the balance sheet. Legal form suggests that we don't. And given that the standards are an economic-based idea, we're going to bring it onto the balance sheet where we can. So where does this fit within the framework? So I mean, by this stage, you should have a pretty good idea what an asset is and what a liability is. There's that focus on control. So it's not that you own it, there's a focus on control, and there's that focus on a present obligation. So that should be relatively clear at this point. So we're going to have a look at AASB 117 on leases and just step through it. Now, I'll just start off with, there are two types of leases. There's a finance lease and an operating lease. And you've kind of got the idea from the things that I've been talking about, which is which. I'll actually start at the bottom of what an operating lease is. Now, an operating lease is just a catch-all for every type of lease other than a finance lease. So if you haven't been able to figure it out as a finance lease, if you've got a lease, it's an operating lease. So the finance lease is actually the one which is defined. And it's defined as a lease that transfers substantially all the risks and rewards incidental to ownership of an asset. Now, whether or not you actually gain ownership of it at the end, that may happen, it may not. It is important in a sense as to figuring out if it's a finance lease, but it's not the critical thing. So, the standard then goes and talks about, in paragraph 10, and then gives you more details through the next few paragraphs of what sort of things to look for. Now, before we run through these 5 items here, have any of you seen, it's a bit of an older Australian movie, so it may not have too wide a viewership, but have any of you seen The Castle, the movie The Castle? Damn it, it's not going to work as well. But the idea of that is, it's not with these 5 things, if we tick off 3 of them, it's a finance lease, or if we have to tick off 4 of them, we have to tick off all of them. You could tick off 1 of them and you could argue you've got a finance lease. It's about, to quote from The Castle, it's about the vibe of the thing. It's just sort of getting a sense of how it just feels, and if it feels like it's a finance lease, and obviously it's a little bit more technical than that, but if it feels like it's a finance lease, then that's what it should be. Now, things which will give you that indication, if you get ownership at the end of the lease, that's probably a pretty good indication that you have a finance lease. But you don't have to take ownership, and that doesn't preclude it from being a finance lease. If you can buy it for less than its fair value at the end, again, that's probably a good indication, but it's no guarantee. You're going to use the term is the major part of the asset life. Present value of minimum lease payments are substantially all of the fair value of the asset, or the asset is very specialized to what you're doing. Now, I just want to have a look at, just want to point out a few of these. Now, if you think of transfer of ownership at the end, that's, or even an option to buy, you know, those, I mean, there's a level of subjectivity in there, but you know, it's probably less so than the next bits. But this is what our standards are about, in that they're very much a framework-based view, sort of a principles-based set of standards, not a rules-based set of standards which the US have. So the lease term for a major part of asset life. That's subjective, what that major part is. Do I see 90% as major? Do you see 75%? Do you see 60%? What constitutes a major part? And so there's professional judgment being made in those cases. Same deal with substantially all. Is 99% substantially all? Is 90%? Is 85%? Now, that may, like on one part, sitting in a classroom going, yeah, well, you know, how important is that? But if that means you're able to shift something off balance sheet and you're talking about sizable assets, those decisions and those judgments suddenly become really important. Interestingly though, the US have similar idea, except instead of talking about a major part, it's 75%. They've actually given you a hard definition. So you'll often see leases at 74% over there because it makes sure it's as long as they can without actually falling into a finance lease definition. Same with present value of minimum lease payments. Substantially all, in the US, they quantify that as 90%, and that is actually a hard rule there. So, and what you can imagine, I mean, we seem to follow the Americans in a lot of things, that even though we don't define any of these numbers, when people are looking and making judgments on these things, they consider 75% and they consider 90%. They think about those things as benchmarks to work from.